Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take us off course how to make it actionable, understandable, and clear. What a last week of school, and therefore what a show. You're not going to want to miss this one. Perhaps the children have less homework. Bring them in for this. We've got an excellent agenda. At the top, this is kind of a friends and family question, an excellent question posed to me. Should I just buy Berkshire Hathaway stock? All this news about Mr. Buffett's retirement, this is in lieu of an index fund. I think it's a great question, deserves a good answer. We're also going to look at, are stocks expensive right now? Wall Street Journal article and some of the underpinnings behind that question. We also have a wonderful segment coming back. So you think you want to be a stock picker. This time to the positive. We're going to look at an instance where a friend of the show made a wonderful move and just the right way we are supposed to think about that. And then some fun Vanguard news. So great lineup. Let's bring it back to our beloved Berkshire Hathaway. So I'm at a lunch, and a friend of the show mentions, hey, look, with all this index fund talk, is it possible that we could consider Berkshire Hathaway a pseudo-index? In a sense, an index, because they hold a wide range of companies. And by way of review, this is Warren Buffett's holding company, Berkshire Hathaway. He's had since the mid-'60s. That owns a whole host of companies, including Geico and a number of others. Large positions in Coca-Cola, large positions in various banks, and he owns BNSF Railroad. So a true diversified holding. Why would we not just buy their B shares? Their A shares are very expensive to buy one share, but why not buy the B shares and call it an index? And I thought, that's a fine question. Why wouldn't we do that? I think what is behind the question is historic return and data, performance data. Every year I've been alive, there's been someone saying, I've been alive 39 years, there's been someone saying that Buffett's lost it, that Berkshire Hathaway will not be able to survive in the upcoming decade because of this reason or another. So, and here's why. Oh, eventually they'll be right. Eventually Berkshire Hathaway will have some sort of a cataclysmic move that leads them to mediocrity. They haven't yet. They've been nothing but excellent. But we only know that in hindsight. So when we say, hey, what if I just bought Berkshire? Would we have said that in 1970? Maybe not enough performance data. Or maybe Buffett just did really well in that period. What about 1980? Could we have said that? People didn't. Everyone would have jumped on the bandwagon. What about 1990? More people were aware of his prowess. But in the late 90s, he was written off as a know-nothing. Couldn't keep up with the technology revolution, didn't understand how these companies were going to change the world, and he confessed he didn't either. He ended up being prescient in his prediction that many companies were overvalued. 2010, 2020, every decade we look back, and now it's, in 2010 he's too old. In 2020 he was certainly too old. He has proved the doubters wrong. The question for you and I is, would we have been able to make that choice with confidence? I ultimately had to say no. Now, here's why I think buying Berkshire B shares is a fine strategy. If someone told me, Robert, I just can't get on board with indexing, I just don't want to do it. Too many companies. And even though it's effectively free through the Vanguard Group, through the Exchange Trade Fund, I don't like it. I'm just going to buy Berkshire B shares. Wouldn't fight them. Now, the challenge I'd give to them is, can you hold those B shares for 50 years? And can you hold those B shares when there's a 10-year period where everyone tells you you're a fool for holding the B shares? The beauty of the index fund is you own everything, including Berkshire Hathaway, who's maybe your 9th largest holding in a United States index fund, something like that. You can survive the psychological onslaught, which is one of the hardest parts of investing, is just sticking with it. So, permissible? Yes, buy those Berkshire B shares. Advisable? No, I wouldn't. I think it is going to be an incredibly difficult journey to hold any individual security for any length of time which is, as you guys know, that time horizon needs to be long. The children probably answered there for you, long. And how do we make it long? We got to stay diversified. So, great question. Yes, it's a pseudo index. No, I wouldn't treat it like an index. Yes, it's permissible to buy. No, it's not advisable. We now look to valuations. Now, in this podcast history, I have a tendency to sneak back and look at Vanguard's capital market survey, which is a prediction engine for Vanguard with a big asterisk by it saying, we have no idea if this will happen or be real, what have you. But it looks at the pricing of stocks and bonds and cash and commodities today and looks at historic pricing and returns and extrapolates to the future what they think your returns will be. Well, there's a Wall Street Journal article by Mr. Sam Goldfarb that's within that vein. And I found out, I was checking Vanguard's capital markets survey. A client asked a good question I didn't know the answer to. And I said, well, let's just see what Vanguard thinks the returns will be. And they had adjusted them. Believe it or else, they've moved their expectation for United States stocks up higher than it was previously. They still think international will do better, but I guess something changed. And it's a dynamic model. I don't think we should put too much weight in it, but I think it can be helpful to just get in the game. Well, this article talks about the different ways, Mr. Sam Goldfarb explains, different ways we can value stocks. Just how expensive are stocks after all the ups and downs? ? We check the math. Subheadline, a look at different methods for valuing stocks and what that might suggest going forward. Now, the granddaddy of them all is something called the price to earnings ratio, or the slang PE ratio. It's a way to value how much am I paying per dollar of earnings. So a company, they have various costs, they have revenues, the revenues minus those costs, simplistic language here, creates their earnings. Well, you want to know, okay, for every dollar of the company's of earnings, how many dollars do I have to put down to buy that $1? Well, you can put this for the whole market and look at an evaluation and say, historically, it cost X to buy these dollars. Now it's cost Y, sometimes more, sometimes less. That's a way people can see, is the market expensive or not? So they'll look at typically this individual company, the past article explains past 12 months of earnings, or analyst expectations for the next 12 months of earnings, or they'll adjust it. They'll average annual earnings of the past 10 years. They'll adjust for inflation. To keep it simple, just remember price to earnings. It's just like it sounds. What's the price per dollar of earnings? So this article says when the whole S&P 500 is looked at, these various price to earnings models show investors paying a high price for every dollar of earnings compared with what they have paid in the past. Ooh, are we scared? What does that mean? I think this article does a good job of hedging their language. They have something called an earnings yield, which they effectively just flip around the price to earnings ratio, so you get a percentage. It shows today's S&P 500, that yield around 2.8%. And they oftentimes will compare this to the inflation-adjusted 10-year U.S. Treasury to figure out, hey, our stocks or bonds, what should I buy? There's a gap there. Famous Robert Shiller, he's got great data. He's over at Yale. He lets us see that, investors are eager to buy stocks and they're willing to accept a smaller premium for their losses. So he's, this way of looking at earnings yield measured against Treasury yield shows, Shiller thinks it's a little expensive. History can be our guide. So, you look at historic valuations. So a good example here is the danger of doing that. The roaring 20s, late 20s, and 1990s tech bubble, there were years and years where expensive markets kept getting more expensive. And investors couldn't stick with it. Couldn't stick with it. Time horizon long. So with all these valuations, I think we've got to consider solving for what matters most, and that's how do we stick with something? I find people that use these valuations as buy and sell indicators, they're in a bit of an insane asylum because you can find any indicator you want to justify a buy or a sell. That's the problem. That's what a market is. It's buyers and sellers coming together on an agreed upon price, all with their own heuristic lattice work of models they have on what dictates whether it's a value or not. There's this man named Aswath Damodaran. He's a professor at Stern School of Business in New York University, NYU. I think it's kind of a 1-year program to get into A&M, some sort of a feeder school. But he's the dean of valuation. He's actually great if you really are into this stuff. He's got this like 1998 looking website, but it's wonderful. He's got his own estimate of the risk premium that stocks offer over bonds. He looks at the analyst expectations for the company's earnings growth. He says stocks are more reasonably priced. Using that metric than the other metrics. So he uses this to buy individual stocks. He's a funny man. He understands the nature of index funds and how effective they are. He so loves researching individual companies that he ends up buying 40 individual stocks. And I think he's confessed to underperforming the index, but still sticks with it because of how much enjoyment he has running his models on his individual securities. That's an honest man, isn't it? Very honest. And then this article concludes with, hey, look, had you followed this kind of theory on when to buy and when to sell based on the U.S. Treasury versus the S&P 500 and that yield, you could have returned 0.5% more over a 60-year period if you had just bought and sold at the correct time. Now, that sort of strategy scares me to death. Yeah, you've got 60 years and you've got to be faithful to this buy and sell strategy. Can't mess it up. Can't get scared. Can't have any sort of execution risk. No way. I would rather keep that time horizon long so I'm not having to deal with thinking about it. I suspect it's right, though. I say, look, there are moments where maybe it appears like the stock market's overpriced, underpriced, whatever. I like the way we think about it, listener. Let's keep that investing simple. That violates one of those rules. The idea that you have to go in and out of the market. Ooh, just sends shivers down my spine thinking about, you get an email from your terminal saying, beep, boop, beep, boop. The earnings yield has gotten close enough to the treasury yield. You need to liquidate securities and buy bonds. And then you get another, and who knows if it'll work. This goes back to the Buffett thing. Maybe it worked great over the past 60 years. What if it has a bad 60 years of the next 60 years? It happens. Countries have bad 60 years. Why can't a stock market? So let's keep it simple. And then I found this data fascinating. This is Eric Balkunas. I don't know him, but this is on the X platform. He has an ETF revenue table. Exchange traded fund. You remember those ETFs they're kind of like mutual funds, but they trade throughout the day. And they've helped accelerate the advent of low-cost investment products because they're typically cheaper than mutual funds. There's a list on who has the most assets in the ETF space and the revenue associated that they make, and on and on. And this is in trillions of dollars. So BlackRock is the leader. They've got what amounts to $3 trillion, and they make their fee income from that's about, it says $5 billion. Yeah, I guess so. It's not very much, but it's a lot compared to Vanguard. So it's got this list of BlackRock, Vanguard, State Street, Invesco, Schwab, JP Morgan, First Trust, and it shows the blended expense ratios of all their ETF products. Wouldn't you know it? Vanguard's the cheapest by a lot. By a lot, listener. BlackRock's is 0.30%, pretty cheap, but Vanguard's is 0.06%. The entire universe of ETFs Vanguard offers is 0.06%. State Street, 0.27%. Invesco, 0.37%. Schwab doing pretty well with 0.12%. Now check this out. First Trust had $200 billion in assets. They make more money on their $200 billion than Vanguard does with their $3.1 trillion. What does that tell you? First Trust has a 0.71% blended expense ratio across their family of ETFs. Again, compared to Vanguard of 0.06. I found the table fascinating because, one, it shows just this is all a force for good. These prices I'm reading to you, this 0.30 or 0.06, you could have put a 1 before it back in the old days of mutual funds, or a 2 even, 2.3. I mean, these people will charge you as much as you let them. Now, Vanguard effectively forced the entire industry to adopt and offer low-cost products. But why do I like sending people to the Vanguard ecosystem? as opposed to these others I've listed. These others I've listed, they're going to try to sneak you into the highest cost ETF or investment product they can. That has been my experience. You name it. And I will still recommend Schwab or Fidelity. But with any of these, they are organized and designed to try to push net income. That's what they want to do. Nothing wrong with that. You as an investor need to advocate for yourself. Vanguard, being a mutual fund company, essentially a not-for-profit or operates like a credit union would for the benefit of the membership. My slang is the world's largest family office is Vanguard. So if you ever want to tell someone hey, do you have a family office? It's like, yeah, I do. Thanks for asking. It's called the Vanguard Group. And it's me and, a couple million of my friends. It's still the best place to be with your money. And then in closing, I thought this was interesting. So you think you want to be a stock picker. Friend of the show sent over a company I had never heard of, embarrassingly enough, but that had just done fabulously well. It was called CoreWeave. They buy GPUs from NVIDIA and have a cloud solution so you can use them, yada, yada, yada. But the company's market cap is around $50 billion. In the last month, it's up 208%. And this particular friend of the show had actually done kind of well. It kind of bought and sold and didn't do it perfectly, but did a great job. And when you look at a chart like this, it's a bit like Eve looking at the forbidden fruit in the garden. Okay, here's the danger. Here's the risk. How fuddy-duddy does your index fund sound when in a 1 month, you could have earned 208%? 1 month, one security, 208. Your index fund, that sounds like a good couple decades, listener. Like in the last 10 years, the U.S. market's done great. It's up 160%. That's less than the 1 month of CoreWeave at 200%. Here's the danger. Here's the risk. What do we do with that information? Because there are those moments where, so you think you want to be a stock picker where it's super, oh gosh, good to see it. Glad it didn't work. I'm Mr. Index Fund. What happens when it works? What do you do when individual security selection works? Well, one, I'm okay with a little bit of fund money, less than 5% of your net worth. If this is your thing, do it. Maybe you do really well. For the rest of us, go back and look at that SPIVA report. You're not doing this in a vacuum. For every buyer, there's a seller. The SPIVA report shows the performance of actively managed funds versus the index fund. Shows there's a 5% chance, typically over a 10-year period, those active funds beat the index. So even when you hear of a story or see a story, or you yourself have a great pick and it works, you've got to remember there are armies of intelligent folks who probably did their undergraduate work at Texas A&M, who are spending hours and hours and hours, days and days and days with great AI models seeking to properly value stocks, and there's only a 5% chance those armies of people beat the index. 5%. So we must have clear-headedness. Otherwise, the psychological factors involved in making quick money are so powerful, we can be prone to believing the lie that you can just do it, make money quick without major risk. So what do you do, listener? What do we do? Let's keep those costs low, that investing simple, and that time horizon long, because that's what's going to give you the best shot on your investing journey. Happy last week of school.